My name is Mike McCowan, and as the president of the Benefits Alliance Group, I'm really excited to introduce today our speaker, Rahim Bhayani. As many of you know, our keynote speaker series are focused on highlighting the challenges and the issues facing employers across the country. We are really excited to provide this thoughtful content to all of our advisor firms across the country. And as we end 2021 in our final keynote speaker series for the year, we wanted to end on a topic that actually has been requested by many of our advisors from across Canada. So as the title suggests for today, we're here to talk about the ABCs of compensation. And as I've mentioned in every introduction for these keynote speaker series this year, the pandemic has truly changed the workplace. For many employees, what they look for in a role has also evolved. And for this reason, employers are continuing considering how to provide a holistic approach to compensation, which is going to both attract and retain talent. I'm really excited to present this session with Rahim as he has some excellent takeaways for all of you who are considering the topic of compensation or maybe setting your comp budget for 2022. Now, a bit about our speaker. Rahim is the head of global compensation at Elastic. He is also the managing director of Principal Rewards Consulting. And if this guy wasn't busy enough, just a few weeks ago, he also became a new father as well. Rahim's career also includes times at OMERS, TD Bank, and Ernst Young, all in the capacity of compensation. Many of us have had the opportunity to hear Rahim speak before, and he truly is a trusted source in the topic of compensation. Now, as always, if you do have questions, please use the chat function below, and I'll be answering a handful of these questions at the end as time permits. We want this to be as interactive as possible, so I really encourage you to ask the questions which are important to you and your employees. So with that, I'll be back at the end, and it's my pleasure to help introduce Rahim.
Thank you very much, Mike. I really appreciate that. Great intro. And fatherhood is going fantastic second time around, so no complaints. Everybody is healthy and happy and good. And I'm very happy to be part of this series again. I did this a few months ago with Mike and team, and so happy to be back talking a little bit about compensation in the context for sure of a post-COVID or during COVID world, but even broadening it out to say COVID has just accelerated changes that are happening societally, perhaps, and I'll get into some of those in a second, and how are companies dealing with that in the context of compensation. A lot of interesting stuff going on, and happy to share some trends and insights with you. Mike did a great job of my introduction. I have spent, 21 or 22 years now. I kind of stopped counting after 20 in the field of compensation. Right from university, I got into compensation at Deloitte and Touche. Deloitte Consulting now, 21 or 22 years ago, it was Deloitte and Touche in New York City. So I've had good exposure to both the United States and Canada, and now very global. So hopefully some of the insights that I share with you are relevant to a very small company that's local to large or mid-sized companies that are North American wide or perhaps global in nature. So with that said, we'll get into the presentation. There you go. I'll speak to generally 8 topics, as you can see arrayed out here on this slide. We'll start with some market trends, and it's accurate to say market forces because there are big forces at play. And to just say trends is actually to minimize what's going on in the industry right now. We'll talk a little bit about employee value proposition. Some of this lingo might not be super familiar, but it's very compensation-oriented languaging. And I'll talk a little bit about what is the employee value proposition and what can companies do to surface the full employee value proposition. We'll talk a little bit about market competitive positioning. Again, that's more industry jargon, but I've put it in a little bit more deliberately to say, you know, this is the kind of stuff that a compensation person would think about and companies should think about in a more sophisticated way. So here's kind of the language that goes along with it. We'll talk a little bit about the total rewards framework and what that means and what are different types of frameworks. We'll talk about tax efficiency and dollar optimization, because budgets are finite. And so for companies that, have obviously finite budgets, to stretch that dollar and to make it as efficient as possible, there are a few tips and tricks to do that. We'll then get into compensation plan design. And there's a lot of stuff in plan design, so we won't be able to cover too much of it, but this will give you as advisors in particular a flavor for what are the things your clients might want to consider as they think about compensation. We'll start to kind of wrap up with pay transparency, and comms is just short for communications. Why are those things important in compensation? And then, we'll end with, well, now what happens? You've got a little bit of insight now in the next 45 to 50 minutes. Where do you go from here? So we'll start with market forces and trends. Truly, the first bullet point is very accurate. I have never seen an environment quite like it is now that's so favored in terms of employees. Typically, companies have the upper hand. Employees generally don't. This is the first time I have seen the environment so tilted in the employee's favor, which just means there's not enough labor for some of these really well-paying jobs, and employees have pick-up jobs, really. And that is changing the environment quite a bit. Remote work is one of those things tied to the first point here. There are companies now, American companies, companies from the UK that are sourcing their talent from Canada. Why? Canada is known as a fantastic university ecosystem with graduates that are highly capable and not as expensive as the labor pool in the US or the UK. So Canada is very attractive to global companies. They are recruiting everywhere in Canada. It's Toronto, it's Montreal, it's Vancouver, but also it's Winnipeg, it's other parts of Alberta, it's all over the place. And that is creating a lot of problems for every other employer in Canada that is trying to do the same, because if Microsoft or Google or some of the other American US companies come in with a US-based package, which is usually quite lucrative, it is hard to say no, especially when you can work remotely or from the comfort of your own home or what have you. And that is creating a lot of talent disruption, which we have not seen ever really in the marketplace. Tech companies in particular, I talk about because they are the ones that have a lot of equity to throw at employees. By that, I mean pre-IPO equity in the organization. So pre-IPO shares in the organization. There are a whole host of companies out there. If I just think about the tech landscape in the US, I would estimate there are maybe 10,000 very good, desirable pre-IPO companies that are recruiting in Canada and are very happy to share US dollar denominated equity with even mid-career or junior employees, not just the senior ones. That definitely has a bearing on the talent market, because if you are a Canadian manufacturing company and you're trying to hire a finance manager, and that finance manager can go work for an American company sitting in Toronto, Ontario, from the comfort of their home, that is competition that the Canadian manufacturing company never had before to deal with. So all new stuff to deal with. So what are companies doing with all this labor sort of backdrop? Companies are absolutely getting creative with every component of work, but more so on the non-cash components. What I mean by that is employee recognition, work flexibility, working remotely, work tools, collaboration tools. That matters a lot to employees. If there are good collaborative tools that an employee can use to make their work life easier while working remote, that is a big deal. Meaningful time off. A lot of companies have gone to things like unlimited time off and time off on demand and all those sorts of things. Volunteering opportunities, mission-led work. And so companies are really branching out to really understand what an employee is looking for when they come into an organization. It's no longer about, what's my base salary. It's about what is my base salary? What are other components of compensation? And then do I actually want to work with this kind of company? Do they have a mission? Do they have a vision? Are they good stewards of the environment? Those are all things that employees today are asking a lot of questions about. And so companies by necessity are absolutely getting creative. Um, Another trend that is very interesting is democratization of compensation data. So in all my years of doing compensation, never has there been a time where so much data is available just on the internet for free. You can Google this stuff. What does a line manufacturing person make in a factory setting? What does an accounting manager make? What does a software developer make? It's not just salary.com, by the way. There are tons of other websites and group sourced, I would say, salary or compensation information. And in many cases, the data is actually pretty good, I would say. I can't say I would put all my eggs in that basket, but the data is generally pretty decent. So whatever the group source data is, it's a good indication of what's happening in the market. So a lot of employees are now armed with very real information about what their worth is in the market, and that is being used to negotiate with companies. Again, this is the first time I've seen so much of this happen. Pay equity is a huge deal now, both from a gender perspective, but also from a race perspective. Employees are just getting far more educated about the fact that there is such a thing as pay equity legislation out there, and employees are asserting their rights to have equitable pay opportunities. Again, a first in my career. I have never seen employees this empowered before on pay equity. So lots of very interesting trends happening for the first time. To compound issues, inflation is persistent. I mean, we've all seen it in the news, but it is quite real, and it's showing up in the cost of labor data as well. So, for those that might have done some economics in their university life, inflation eventually does put upward pressure on wages. It creates a whole pile of issues for companies because, when wages start to go up, companies that don't have a lot of budget to keep increasing cash incentives or cash salaries need to get, again, creative with other value propositions that they might have, which leads to my last point. Companies are absolutely looking into smart ways to enhance their return on investment on their compensation without actually spending more money. So something simple that doesn't cost anything could be really, really good communication about what the compensation package is. Because my experience is a lot of employees outside of base salary, a lot of employees don't per se understand all the various components of total rewards, things like RRSP matching. A lot of employees do not know that a company has a match. If they do know the company has a match, they're probably not aware of the percentage match. If they somehow are aware of the percentage match, they're not taking full advantage of the match. So there's a lot of things that a company can do to educate and communicate that doesn't cost anything more. And the smartest companies are definitely trying to do more of that. Lots of stuff going on in trends. So the first thing we'll talk about relative to that backdrop is the employee value proposition. It is a cost-free way of surfacing value of the total rewards package. In very broad terms, if you have a fantastic healthcare program at a company, but nobody understands it, or it's too complicated, or you've never communicated that before, it doesn't exist as far as an employee is concerned. It's really as simple as that. If they don't understand it, it does not exist. So I always talk about benefits plans because a company pays a lot for benefits to the extent that they have an employer paid benefits program. If an employee has a spouse, and in my example, 3 dependent children, perhaps the company is paying up to $25,000 for benefits for those 5 employee plus dependents. How many employees really actually understand that? And of course, a lot of benefits are tax optimized. So if employees were to pay for this out of pocket, it would be quite problematic for them and quite costly for them. But not a lot of employees actually understand that or think about benefits when they're considering their overall package. So these are things that an employee value proposition, call it a document or a manifesto or or an employee value proposition project would get out of, which is to really, really crisply explain the full package to employees so that they really understand, what do I get from working at this company? That's the value proposition. Um, a good litmus test is, can they explain their compensation program to their spouse or colleague? Can they draw it on the back of a napkin? Uh, I see a lot of very senior executives who do not understand how their bonus plans work. I see it all the time. These are very, very smart people who know a lot about the business world, but compensation plans tend to be communicated in a complex way, uh, if at all communicated properly. And if senior executives have a hard time understanding the compensation plan intricacies, you can only imagine, people that are not at the top, and how much they might struggle with understanding a complex compensation plan. Are there any unique, compelling features in the company's compensation plan design that are a unique draw for an employee? So what would that be? It could be something as simple as 100% employer paid benefits. It could be a really fantastically great RRSP matching. It could be that they pay for employee college tuition. It could be unlimited time off. It could be volunteering opportunities. It could be so many different things. Is there a unique feature that not a lot of companies have that you can double down on? And then, the last thought here for me would be, it is not actually easy to calculate non-cash benefits per employee. In the example I mentioned, the $25,000, the 5,000 times 5, it's really nice and simple. It's actually not that easy to calculate. And there's a lot of complexity that goes into calculating that stuff. But has the company got the ambition to do it? Would they like to understand that? Do they have the right people in-house or even in their consulting ecosystem that can go about doing that? Because that is a very powerful piece of work a company can do, to put dollars. And yes, you've got to make some assumptions, because unlike cash compensation, I could give you a lot of health benefits, but if you don't take advantage of any of them, maybe they don't exist for you. But the fact that I'm giving you dental benefit or life insurance or other health coverage, there is a dollar value to it. And the smartest companies are definitely trying to figure that out. Market competitive positioning. So this is a very classic, very critical thing that a company can and should do in terms of compensation. Market competitive positioning, as you can see here, simply means the conscious placement of a company's compensation level relative to its competitors or peers. Conscious placement means I am going to pay more than my competitors, or I'm going to pay less than my competitors. It is a conscious placement. And it implies that you actually know who your competitors are, or your peers are. And so, how do you do that? Well, you take a look at market data, and we'll get into that in a second. There is such a thing called market data for compensation, and you take a look at either the 25th percentile or the 50th percentile or the 75th percentile. For those that might be a little bit more familiar with statistics, these are just ways of distributing data and just understanding where in the distribution, where is data in its distribution. So for example, a company might say, I want to be at the 75th percentile of the market. In a nutshell, that is at the upper end of the market. So that's a good high payer. That's a company that has a bit of cash. They're willing to spend it on employees. And generally, if a company is spending at the 75th percentile of the market, employees are getting paid well. They're quite happy with their compensation, generally speaking. And just mathematically, that means that this company is paying better than 75% of the companies in the peer group or in the competitor list. So that's a great position to be in. Most companies that I know tend to target the 50th percentile, or kind of straight down the middle, if you will, where neither are they the high payers nor are they the low payers. They're kind of straight down the middle. So half the companies are higher than them, half the companies are lower than them. It's a nice, safe position to be in. It is market competitive. Uh, Nobody will complain about being at the 50th percentile. It's not going to attract a lot of employees from the company that's paying at the 75th percentile, but nonetheless, it is a conscious choice. And that's what we need to do as a starting point, is make a conscious choice of what kind of payer do we want to be. To get into this a little bit more and to understand kind of how the market data is arrayed, if you look at the diagram on the right-hand side, there are compensation surveys out there. So imagine, a whole host of data sets out there. And let's pick on a representative job. So a finance manager. Let's say we're looking for a finance manager in the manufacturing industry. And this company happens to make, let's say, engineering parts, car parts, let's say. So a car part manufacturer in Canada is looking for a finance manager, and they're looking at other companies that are also in the same manufacturing industry, either in the car industry or maybe a little bit even beyond that. If you look at the diagram here, each of those green dots represents a finance manager in the industry and their compensation. So you can see here, we've got about 18 or 20 dots arrayed out from left to right. That represents 18 or 20 finance managers in the industry and their compensation. You can see it'd be very easy. It would be very easy for then us to say, oh, okay, I've seen the data now arrayed. And a compensation survey would never give you all the individual data points. They would simply rely on the percentile ranking. So they would tell you what the 25th percentile is, or the 50th percentile is, or the 75th percentile is. And then you get to sort of determine, do I want to be at the high end of the market or the 75th, or do I want to be at the low end or the 25th? And that is a piece of work I would say companies need to do. They need to consciously position themselves somewhere, and they need to get good, reliable market data to understand, if I'm going to position my finance manager at the 50th percentile, I need to actually be very clear on what the 50th percentile of the market is. And then I need to anchor my finance manager's pay at that 50th percentile. And I need a very credible way to do this year after year after year, so that there's longevity in my methodology. So market competitive positioning is a good basic grounding exercise that I would say small companies should do, mid-sized companies should do, and large-scale companies should do. All companies that have a handful employees or more should engage in some level of market competitive positioning, even if it's basic. I mentioned a little bit about the survey houses or the surveys that have this type of data. If you Google Towers Watson or Mercer or Radford, if you just Google them, you'll see they all have compensation survey offerings. Each company is a little bit different. They all have their pros and cons. They all have their strengths and the not so strengths. But all of these companies provide market data. So to the extent a company wants to understand their market competitive positioning, all of these data sets are available to purchase to understand where a company is paying. Furthermore, you can go very specific or a bit more generic on the data cuts. So a lot of companies will say, I'm in the manufacturing industry in Canada, and my revenue size is $5 million a year. So I'd like to look at compensation data for manufacturers that are in Canada that are also clustered around $5 million in revenue. And that's okay, you can do that. You can also go a little bit wider to say, you know what, I'd look at compensation data for companies that are $1 million in revenue to $25 million in revenue. The more broad your criteria, the more data you will gather, the more robust your data analysis will be. And then, the last bullet point here is really whatever strategy or methodology you employ for the first market analysis, it's ideal if you keep replicating that year over year so that the methodology is standard and you don't have to worry about, oops, I changed my methodology, so now I lose my year-over-year comparability of data. So it's good to lock in a standard methodology and then kind of put it on repeat every year. Do you need to do an annual survey exercise? No, you don't. It is ideal to do an annual exercise because market data does change on an annual basis. But if companies want to do it once every 2 years or 3 years, that'll work fine too. It's very good to understand market competitive positioning if you're a company that wants to attract and engage talent. Now let's talk about total rewards framework and what that means. There are a few different ways of talking about this topic. First of all, let's talk about what is total rewards. So beyond compensation, total rewards is career growth. It's, of course, compensation, it's benefits, it's well-being, it's retirement plans, it's even company culture. All of these things are a part of total rewards, and all of these things are things that employees think about when staying at a job or leaving a job. I'll give you a very good illustrative example. I was dealing with a very senior level employee in a startup organization who was being offered a package by this organization, pretty decent base salary, very, very good pre-IPO stock options, no benefits, no pension plan, nothing else. It's just base salary and a lot of stock options. The employee was thrilled with that. The employee's spouse was not as thrilled with that because the employee had 3 kids and they need benefits and they need to think about retirement plans and things of that nature. So in the end, what happened is the employee ended up not taking the job. Maybe it was very lucrative, but the reality is it wasn't a balanced total rewards program. And so, as the employee discussed it with their spouse, it wasn't that attractive. So for companies out there that might be tilting more towards cash or non-cash, it's just the answer would be you want to have a good blend of cash compensation, but also non-cash benefits. I see there's a question logged in, so I'll get to it in just a second. So in terms of if I'm a company, how do I want to think about all this? I need to make some decisions. Am I going to be a company that has a very holistic sense of total rewards? Or am I a company that wants to really focus on cash compensation and forget about everything else? Or do I want to even go more narrow and just focus on base salary, make that the anchor, and kind of put everything else in the background? My sense is, and my experience is, companies usually don't know the answers to those questions. They likely have not thought about it very consciously. And if you were to ask them all these questions, they probably would say, not entirely sure we've consciously elected these things. They've just kind of organically happened over the years. And so I would say this is a good time to step back and say, okay, we need to consciously be thinking about some of these things so that we can definitively say we are a total rewards focused company, or we're a base salary focused company, or whatever it is, as long as it's conscious. There's a question here, so I'll quickly take a look at it and see if there's a good quick response. If there's no quick response, I'll just come back to this group with an answer async. So the question is there a timeline for a position where you had a productive employee for a certain time period where it was worth it for the company, with training being put in by the company? Since employees change careers so often, what is its reasonable time period? This is a great question. So if I summarize the question, the nut of this question is training costs money. Employees tend to change jobs potentially in a little fickle way these days. If they're job hopping every couple of years, and if a company puts a lot of effort into training, is it really worth it if employees keep leaving? Is there a time period in which you want to do training and then not do training to just not waste money on employees that are going to take all that training and go away? This is a hard one because it's almost like you train them, they go away, maybe you don't train them and they all stick around, and that's not a great answer either. So the way I have always seen it in my career, and I've espoused it, is a really, really robust career growth and career development program is never going to be a detriment, even if the employees leave. Employees leave for all sorts of reasons, and that is the nature of the working world that we live in. If a company has a strong training program, that reputation actually gets out there, and you will have a constant stream of potential employees applying to the company. I know a lot of companies that act as that. So, for example, if anybody has had any exposure to Deloitte Consulting, EY, PwC, KPMG, these are fantastic companies if you want to get trained up. And I know a lot of people who will do a 3, 4, 5 year stint at a company like that, really understand the fundamentals of their job super well, because these companies train a lot and train often because they need to. And then at the 3 or 4 or 5 year mark, employee will leave to go either in industry or in-house. And if you ask EY or Deloitte, would they spend as much money on training because employees keep leaving? They'd say absolutely, because we want to be an employer of choice. And as employees leave, there's always a whole host of people waiting to take their place, because they know they're going to get really good training from a high quality workforce, and that becomes a attractor and an engager of talent. So train often, train really well. And yes, if employees leave, it sucks because it's really expensive to get new employees in the door. And that's hard, but double down on training. So hopefully I answered that question. If there's more question in that, let's talk out of this session, and maybe I can provide more context. All right, so different frameworks. It feels like there's a lot going on in this slide, but let me break it down a little bit, and you'll see that there's a little bit of musical chairs going on, really. The first approach, which is what I call a base plus plus approach, is the most simplest. It's simple to understand. It's simple to talk about. It is straightforward, and a lot of companies that are small or even medium sized use it quite often. It is the base plus plus approach, which means that base salary becomes the focus, and everything else kind of recedes in the background or is not as important. A lot of companies do that today. Manufacturing industry does that quite a bit. Even the consulting industry like EY or PwC or Deloitte are primarily focused on base salary, and cash bonuses and long-term incentives are not as big of a focus for junior level and mid-level career consultants. Perhaps a slightly more sophisticated approach, and again, sophisticated doesn't have to mean good or bad. It's just a slightly more sophisticated approach is to talk through a total compensation package, which breaks down into base salary, cash bonus, and long-term incentives. So it can sound a bit like musical chairs, but it's just what you're placing emphasis on. Imagine a base salary of $100,000, but a total compensation of $150,000. I would much rather start with a total compensation offering and then explain to an employee how the various components break down, and explain to the employee that we think of everything in a total view, because that's our employee value proposition, is on the total. And then now we break it down into the various components. That is quite a powerful way to do things. And again, a company should ideally be very conscious about the approach they are taking with employees, because that's the way they'll talk to employees about compensation. My observation is today, companies talk to employees about compensation in a pretty haphazard way. And it's partially because they haven't thought through what kind of approach they want and how they want to talk about compensation. Compensation should be talked about in very deliberate, structured ways, because it is a deliberate and structured thing, and it's very near and dear to an employee's heart, and it's very emotional for employees. And because it is so important to employees, it needs that structure and deliberate handling so that it's most impactful. So the last approach is the total rewards approach, my favorite approach. It's probably the most sophisticated approach. It is uh, hard to do because it's hard to quantify in really easy ways health benefits and retirement plans. But companies are doing a lot of work with partners in the industry, consulting firms and the like, to figure out what are my total rewards? How would I communicate total rewards to employees? Would it sound okay? Would it be accurate? How do I make sure I don't get lost in all the details? But for companies that can figure this out, it is incredibly powerful to actually have a total rewards view because go back to my example, you could have a base salary of $100,000, total compensation of $150,000, but total rewards of $200,000. And I'd rather explain it that way than and then break down the components because I want employees to remember 200,000, not 100,000. Nothing has changed in the budget. It's just I am now focusing on a bigger number because truly that is what a company spends. And so let's shout it from the rooftops. Let's make sure employees know that it's actually not just base salary. It's base salary plus another $100,000 in bonus and other things. And it's all in the communication. A lot of times companies are really, really unaware that excellent communications can make a huge difference in how an employee values their total rewards or compensation offering. Sounds very simple, but I see a lot of very, very smart companies miss the boat on this one. Tax efficiency and dollar optimization. There are not a lot of things companies can do with regards to efficiency, admittedly, but there are a few tips and tricks, and companies should think about those very carefully. The two that I love are health spending accounts and RRSP matches. Every company, I think, should invest in a health spending account, think through a health spending account, or give employees the choice of putting some of their base salary dollars into a health spending account. It is tax efficient. It is something that more and more employees are using these days. And it is just a really good tax optimized way of putting dollars into employees' pockets that is linked to health. And these days, employees are focused, as you know, in a post-COVID or COVID era, health spending is becoming very important. Employees are focused on health and well-being. And an HSA is not only tax efficient, it's real dollars and it's put into health. And I have seen a lot of very smart companies align themselves to being health and well-being oriented. And that is really quite nice for employees to see that their organization values health and well-being of their employees. And that's instant high return on investment because employees like to align with organizations that have their best interest at heart from a well-being perspective. So it plays really nicely into all of that. RRSP matches or retirement plan matches are another fantastic tool that is real dollars for employees' retirement, and these dollars grow and they compound. And so companies need to absolutely think about tax efficiency and dollar optimization. A simple, easy way to do this would be to take a merit increase. So every year, most companies do a merit increase or a base salary increase of some sort. Perhaps give the employee a choice. I can give you a 3% merit increase, or I could put that same merit increase in a health spending account for you. Which would you prefer? Some employees would like the HSA, the amount in the HSA. Some employees might like it in a base salary. But by giving an employee a choice, that will instantly boost ROI with no extra budget needed. Same dollars, you're just now allowing the employee to choose where dollars go, which is fantastic. It is tricky though, because employees at the end of the day need cash to make their life work, to buy stuff, to pay mortgages and things like that. So a company does need to be conscious about whether their cash compensation is actually competitive or not. So for example, if a company does not have competitive cash compensation, no amount of health spending account is going to cut it, because you need to be competitive in the basic level first and then all these things can get added. So it goes back to my market competitive analysis or competitive positioning. A company needs to know where they stand in terms of their competitiveness, and then go from there. And again, I'll talk a little bit about the concept of a total reward statement, just focusing on total rewards and how do I quantify, how do I make these rewards come to life? I pay for benefits, I pay for a health spending account, I pay for a retirement plan, I provide career growth, I provide tuition, I provide all these things to an employee. How do I put dollar figures against that so I can tell the employee I do all these wonderful things for an employee that they typically forget about? And so I'll show you an example of a very good, simple, effective total reward statement in a couple of slides. I'm looking at the time and I just want to be conscious of getting through the material. So I might go a little bit faster on the next 3 items, but hopefully if there are more questions, we can field them during Q&A here or offline. There is a lot that happens in compensation plan design. So that is, again, lingo that you will hear consultants use or people in the compensation industry use. Compensation plan design typically refers to STIP or LTIP. STIP is short-term incentive plans. LTIP is long-term incentive plans. And you'll hear that languaging quite a bit, STIP and LTIP. It's fairly standard industry languaging. And all it is short-term incentive plans refer typically to cash bonuses, and long-term incentive plans refer to either actual equity or actual stock, or a cash-based plan that is more long-term, kind of mimics stock or equity in the organization. So just one tends to be more annual in nature. The other one tends to be more kind of over a 3 to 5 year basis. But they are both typically referred to in the compensation plan design arena. Companies should be conscious about this. Do they want to provide both or just one or none? It needs to be a conscious decision. I have noticed that small and medium-sized companies struggle with LTIP quite a bit. And sometimes these are the very companies that need LTIP the most. If I'm a small to medium-sized company and I have fantastic employees, there's nothing stopping these fantastic employees from going to work for a company that does provide long-term incentives to align them to the long-term health and success of the organization. So if I'm a medium-sized company, I need to consciously think about whether I'm going to provide annual incentives and long-term incentives, or one or the other. I'm a huge fan of long-term incentives. They absolutely align employees to owners. It really, in a way that base salary or an annual bonus simply cannot. You now feel like an owner when you have a piece of the pie in a long-term incentive. And long-term incentive can be very simple. It can be a cash-based plan over a 5-year period that an employee gets some sort of payout if earnings over the 5 years double, let's say that. And let's say if earnings double, I am going to give you $100,000 employee. That's a really simple long-term incentive plan because now you've linked my $100,000 to the company doubling earnings. I'm going to do everything in my power to double the company's earnings. And at the very least, a company should be very conscious of whether we want to do this or not, and what are the pros and cons of doing it. So again, it's a very conscious decision point. And then if they want to get into stuff like that, it can get complex. So they want to understand, how am I going to fund these plans? And ideally, you want to fund them on a self-funded basis, i.e., just to take my simple example, if earnings double, I will pay an employee $100,000. Well, if the earnings are going from, let's say, $5 million to $10 million, I now have $5 million extra of bottom line earnings. I'm now going to pay $100,000 of that to this employee. Okay, can I live with that? Is that a dollar sharing arrangement I can live with? Maybe I can't live with that. Maybe that's too much. But a company needs to do that math and do probably a bit more of that math to really understand, can I stomach the payouts under any kind of incentive plan that I'm about to design and launch? And that does require a little bit of work and thinking, but it's well worth it. If a company understands how much they're paying for what level of performance, and they can communicate that really effectively, that is a fantastic place to be. Aligning incentives. So this is a real case study. You can read it a little bit, so I won't drain all of it here. But in essence, a slow-growing tech company hired a head of sales. This is a true story, by the way. Hired a fantastic head of sales. For the first 8 years, the company had relied upon founder hustle. It wasn't going as fast and as growthy as they would have liked it to. So they hired a fantastic head of sales. The head of sales was wildly successful, grew the business phenomenally. And then, the company didn't actually provide any kind of long-term incentive or long-term equity stake to that head of sales. So what the head of sales kept doing is building the business for the founders, and they never got a piece of that pie, that long-term pie. They ended up leaving. That head of sales ended up leaving because they wanted to participate in the growth of that company. And from where I sit as a compensation professional, when you're looking for a high growth and you've got a head of sales hired, it is very important to align their long-term incentive with the company's long-term health. And that is a great way to keep a head of sales growing. So, this happens all the time. I'm sure many of you have examples where lack of incentives or lack of compensation opportunity led to employees going somewhere else. It is hard to replace fantastic employees, and to the extent possible, companies need to think hard about retaining their best people, and to share some of the long-term wealth creating opportunity is a fantastic way to do it. Pay transparency in communications. This is an emerging topic. I expect a lot more to happen here in the next few years. But there is a big movement towards pay transparency. So as I was talking about in my preamble, democratization of pay data is real. People know far more about the potential pay for a position than they've ever known before. They can Google this stuff very easily now. And what's happening is, in particular, as American companies come to Canada, American companies tend to be a little bit more transparent, in my view, a little bit more open about their compensation ranges. And so slowly, what's happening is employees in North America are getting a good sense of what people are getting paid. And that's new. That's new for the industry. In this example, in my first bullet, a true example, one of my US-based clients converted all California-based accountants to accountants from Winnipeg. And that's great. But what happened is about 15 Winnipeg accountants got paid really, really well now by this American company. And they have more knowledge now about how compensation works in the US. This is happening a lot all over Canada. And this is something that companies just need to keep an eye on, because democratization of knowledge is real, whether companies like it or not. And they need to know how they will defend their own position when asked by employees. What is the value proposition? What is the pay range for a particular job? Why aren't you more transparent with your pay ranges? Do you even have pay ranges? How do you know your pay ranges are accurate? These are all questions that employees are asking more and more, and companies need to just know what their position will be on these things. A company is well within its rights to not be super transparent. That's okay. It just needs to be a conscious decision, and it needs to be well thought out so that there's a clear narrative and a clear answer to the employee of why we don't believe in being as transparent as somebody else is being, perhaps. So that's important. As I mentioned several times, companies are not very good at communicating. It's a huge missed opportunity, because very, very good communication of compensation, it really enhances in the employee's mind the employer's brand, the trust. There's high ROI on this stuff. And I think companies do need to really think about communicating with employees in a different way around compensation. A lot of companies are afraid of compensation conversations or putting things in writing around compensation. I would say it is important for companies to lean into this topic, not be afraid of it. In fact, embrace communications as a way to get more ROI on all the budget they spend on compensation anyways. That would be my view, at least. So here's a very simple example. It's a little bit small, but I'll try to kind of tell you what's going on here. This is an example of a compensation statement, and there's a million out there. So if you just Google total reward statement or compensation statement, you're going to come across a whole host of these things. I've actually put in a link of where I got this statement. There's a million out there. I've designed my own many times. I just found this to be very nice and easy and colorful. And I thought, this is great. This is a great example of what a total compensation or total reward statement needs to look like. First of all, you'll see that there's a bit of a communique on the left-hand side. That is fantastic. A lot of companies I know, particularly in Silicon Valley, in the tech industry, these very complex companies are doing very simple communications, very heartfelt communications to employees, which is fantastic to see. It's just a letter from typically the CEO to an employee. It looks exactly like this one. I've worked with some really big, very household technology company names that all of you would be very familiar with. And this statement is something that they would absolutely do. Like a nice letter on the left-hand side. And then on the right-hand side, you see they've got my pay, my health, my wealth, my life. They would describe the various components of compensation in a really simple way, kind of like here. And then what I thought was great is this company looks to break down compensation into the various components. So my pay, which I presume is base salary in the case of this individual, is $130,000, but the total compensation is 153, and they break down the other 23,000, which is fantastic. Just a very simple example of how powerful a compensation statement can be if effectively communicated. This is a nice, easy statement. It's not complicated, although I can assure you that to calculate the fact that everything outside of base salary is $23,000, that is not a simple thing to do. That took a little bit of math, a little bit of modeling, but it's well worth it because an employee, instead of just thinking about the 130 in base salary, they're now thinking of 153 in total compensation, which is great. So now what? I've talked for about 50 minutes and given you a lot of things to think about, hopefully, or a lot of potential projects that a company can do at least. Where do you go from here? My experience is small or medium-sized companies do not have in-house compensation people. If they do, that's fantastic. To the extent that they don't, a good rule of thumb to hire an external consultant is a blended rate of $200 an hour. That is just a very high level rate. There are many consultants slightly below that number. There are many slightly above that number. But 200 is a good, simple ballpark to keep in mind. There are many different ways to also do projects. Some consultants will do a fixed fee project. So they'll do a market competitive positioning analysis for, let's say, $5,000. I tend to worry about that a little bit more personally because as a company, I have no idea whether the $5,000 is high, is it low, is it fair, is it not fair? I would say my advice is ask lots of questions on the breakdown of the fees, try to get as granular as possible, and check with a couple of people in your network as to whether the fee quote is appropriate or not. Similar to what you would do if you were doing some renovations in your house, you would probably get a couple of quotes, you would compare them, you would talk to people who've done this type of stuff before. Same thing applies to compensation consulting. And I'd feel free to explain to the consultant that this could be a longer term partnership if all goes well, because typically compensation consulting is a longer term partnership. So just, it's worth throwing that in there. Make sure you also know that a compensation consultant has access to market data. If they don't, you need to know that. Sometimes they'll tell you to purchase market data. So it's always good to know where the market data is coming from, so that there's no surprises on the other end. External data is not exactly cheap. So, you'll see here, I've kind of got a high level ballpark of $5,000. Typically, that's the cost of a survey, a compensation survey. The cost can go lower or higher, but honestly, that's a pretty good number to keep in mind. And you'll need to know who's paying for that so that there's, again, no surprises on either side. Lastly, what project would a company do? It depends on what stage they're in and how big they are. For small to kind of early stage companies, you got to get the basics right first. So you need to know your market competitive positioning, and you really need to know that your base salary is appropriate and market competitive. That may be it. As you mature, you start getting into things like compensation plan design, short-term incentive plans, long-term incentive plans, and as you'll see on the slide deck, which we'll share with you, plus. A lot more can be done as the company goes more sophisticated and bigger and broader. But at the core of it, I would say market competitive analysis to make sure that the company is paying appropriately is kind of a very, very important thing to do. I see a question come in on, can we get tips on how to choose a compensation specialist with the slide deck? Yes, I can share some tips. I will tell you, it's for whatever reason, compensation specialists are hard to come by. They are not all that available unless you go to the very large firms. So if you're looking for independent consultants, definitely need to do some due diligence and digging to make sure you get the right person. And yeah, I'll be happy to share some thoughts on that as well when we send the slide deck out. Thank you for the question. Good one. There is another question on most recent surveys that I have seen put salary as number 3 or 4 as to one of the reasons for wanting to go to a certain company, where many years ago, this was not the case. You did address this a little bit already. Any comments? Yeah, I would agree. Salary used to be almost the number 1 reason a decade ago as to why a person would go to this company or that company. Today, it is definitely not that. I would say people are a lot more conscious of the total rewards, benefits, retirement plans. People are also getting really smart about long-term incentives. American companies, I'd say, are influencing that a lot. The tech ecosystem is influencing that a lot. So employees want to know, what is my long-term wealth creation opportunity? What are my career advancement opportunities like? Do you guys have a way for me to grow and mature in this organization over the next 5 to 10 years? Or is this just a short-term stint? So yes, employees are getting very, very sophisticated on how to think through a compensation package and how to really size up a company. Employees have all the power. They've got 3 or 4 or 5 companies to choose from, and they are absolutely sizing up an employer every single way they can. And it's absolutely no longer about base salary. That is for sure. Companies need to be very smart about a total package and a very holistic offering. So bang on, great question. So with that is the formal presentation. Mike, I know we've got actually we don't have a minute. I thought we might have a minute for any other Q&A, but we're at time. We're at 3 o'clock. But if there are other questions, Mike, I don't know if there's a forum for people to put in questions, but I am happy to take questions on email, and we can provide those email addresses and details, I think, when we send the deck out. Is that correct, Mike?
Yes. Rahim, first off, thank you so much. Some really practical, great information in here. Even as someone who's looking to talk about comp projects, these last 2 slides alone were super helpful. We are going to stay on just for a few more moments. So for those of you who join, as always, these sessions are recorded and available afterwards. So Rahim, quickly to kind of kick off, you did talk about surveys a lot. You mentioned a couple, but for those in the audience who may be looking to purchase, any other thoughts on, affordable surveys out there that maybe people should be aware of?
Yeah, there are actually a whole host of surveys. There's a company sort of in Ontario, Toronto, Ontario, by the name of the Talent Company, as an example, that'll do custom surveys. I know a few other houses do custom surveys. Gallagher and Associates have a few custom surveys they do. So what I can do, Mike, is put a little bit of a list together of, beyond the big companies, what are some of the other companies? I think there's the Western Group in Alberta, if I'm not mistaken, who puts out some nice survey materials. There are definitely a few, 5 or 6 other surveys to think through. There's a whole host of comp information out there, which is very high quality. And I've also done custom surveys, which are harder to do, but very useful. So I can put together some of that info as well in the email write-up.
Awesome. Awesome. Now, question that I have, we hear a lot about the great quit or the great resignation that's going on right now, or supposedly going on right now. As an employer, how, what's the best way to adjust comp programs to, try to limit that change?
Yeah, this is a great one. Get ahead of it big time. I'm seeing this with my own company as well as a whole host of others. So first of all, the phenomenon is absolutely real. Employees are resigning really in droves. That's what I can say. Attrition rates are 20% plus, which means 1 in 5 employees is quitting. They are quitting because the labor market is tight. They have tons of opportunities out there, and they understand that to stay at one company means you cannot join another, and there's an opportunity cost to that. So, while everybody talks about the great resignation and how employees are doing more soul searching, sometimes it's very practical resigning. It's just, I need to go resign because I'm getting an opportunity from somewhere else that's going to literally give me 50% more in compensation. The only way, there's 2 thoughts I have, Mike. One, you will not save everybody. In fact, you will not save the majority of the people who want to leave. So make peace with that and create a very good bench strength. I know for small and medium-sized companies, bench strength is hard because if you've got a team of 3 accountants and 2 leave, that it's hard in a team of 3 to do a lot of bench strengthening. But to the extent possible, think about continuous career development so that if employees resign, there are people in the team that can even temporarily take a bit more on, and you don't kind of fall off in terms of how a company operates. So be at peace with the great resignation, train employees and have a really continuous bench strength mindset, but also get ahead of it. A lot of companies do retentive equity grants. It is a phenomenal way. If there is a small or medium-sized company that has the wherewithal to do a longer-term incentive program, and this could be cash. This could be a very simple cash program. But if Mike, I can tell you, you stick around with me, you do these 2 things, and I'll pay you $100,000 in 2 years, you might think really hard about sticking around. And companies can design these programs in very different and efficient ways, but get ahead of it for sure, because the phenomenon is real.
That great feedback and very topical. I'm just looking at this slide alone, and one thing that doesn't always get talked about, and you talked about a little bit around transparency, is pay equity.
Yep.
And I'm going to, I don't want to be biased, but I'm going to look at Ontario for a second because that's where I'm based. Any tips or basic tools that employers should be aware of around pay equity and what they should be doing today?
Yeah, absolutely.
And maybe and with that, the risks of not doing anything.
Yeah, great question. There are a lot of inherent risks in not doing anything. First, there's the Ontario Pay Equity Commission. But I think even beyond that, if you are not compliant with Ontario Pay Equity, what that truly means is you don't have a good framework for compensation, which means you're just going to lose people. You're going to lose their hearts and minds, and eventually you're going to lose their work product because they'll go somewhere else. So now what do we do about that? It starts with really basic job leveling. So things that any pay equity, if I think about just the general topic of pay equity, and I'm not really worried about compliance right now, but if I just think about how do I create a pay equity program that's generally equitable, good job leveling architecture, good job profiles and descriptions, a very clear framework of when somebody moves from level 2 to level 3 to level 4. Is that a analyst, a senior analyst, a consultant? You know, that level of job architecturing is critical. And then commensurate with job architectures, pay ranges. So sometimes compensation is willy-nilly and it kind of happens as an employee comes into the organization on the back of a napkin. But if you can create a pay range framework that you can slot people into, you have a lot more likelihood that you're just naturally going to be compliant.
Mhm.
But yes, the way to think about pay equity is compliant or not. I want to have a program that stands scrutiny of pay equity, and chances are you'll be in much better shape with the Ontario Pay Equity Commissioner, or frankly any other pay equity commissioner.
And just to clarify, for an employer who goes, how do I get to that point? If I look at early stage and the list of requirements there, that will help me get to that level.
It will, and maybe there's a bit more around, slightly outside of comp, but very critical, which is the job architecture and the job worth and the job level. Because a lot of pay equity starts with, if Mike and Rahim do similar levels of work, are they paid similarly? And how do I know whether Mike and Rahim do similar levels of work? Because I have a job architecture that tells me that. And so job architecture I would add that as a note on the first box.
Yeah. Well, it's a fascinating topic for someone who's not in the comp space. We could imagine we could probably do a whole session just on that topic.
No doubt.
But Rahim, we are coming to time. So thank you again so much for your time today. Fantastic presentation, so practical. As always, this is recorded for everyone who did attend, and some of that information we'll send afterwards. So thank you to Rahim. Thank you for everyone for joining us today for another keynote session. We'll be back in 2022 for a whole new list of events. So thank you so much, and happy holidays to all of you.
Thanks, everyone.